all know stories, right? Incredibly smart people making, well, just terrible financial
Oh,
decisions.
absolutely. It happens all the time.
But then you hear about someone like Theodore Johnson, just a regular UPS employee.
Yeah, not some Wall Street wizard.
Exactly. Never earned a massive salary, didn't have any complex secret strategy.
Hmm.
Yet, just by consistently putting money into UPS stock, his own company, and just holding it for decades,
He ended up with, what was it?
$70 million.
Wow, 70 million? That's incredible.
It really makes you stop and think about what actually drives financial success, doesn't it?
It really does. It's clearly not just about IQ points.
No.
And that actually highlights a really crucial point, which is kind of the heart of our discussion today. We're drawing from Morgan Housel's book, The Psychology of Money.
Right. Excellent book.
It is. And Housel argues pretty persuasively, I think, that your behavior with money, the psychological side, the emotional stuff, it's actually way more important than how high your IQ is or how much you know about finance.
It's those soft skills,
Yeah.
your reactions, your temperament.
Exactly. Those often overlooked things.
Okay, so for this deep dive, our mission for you listening is to unpack 5 key, really actionable ideas from Housel's book.
Mm-hmm.
The goal here is to give you some practical understanding that can genuinely help you make smarter financial decisions.
And decisions that aren't just down to getting lucky.
Right. We know your time's valuable, so let's jump right in. First concept, thinking about the real cost of investing.
Okay, so think about buying something valuable, something you really want, maybe a fancy watch.
Okay, like a Rolex or something.
Yeah, exactly. You know there's a price tag, right? A specific amount of money you have to pay to own it.
Sure, obvious.
Well, investing, especially if you're aiming for those potentially high returns, it has a cost too, but it's less obvious. It's the psychological cost.
The stress, the worry.
Told all the time. Yeah.
Yeah.
It's like the price of admission you have to pay for the chance of those big gains.
Right. So you might find some companies, maybe tech stocks, with amazing growth potential. You build a portfolio around them.
Concentrated, yeah. High hopes.
The upside could be fantastic, but what you absolutely have to accept or factor in is the real possibility of sharp, sudden drops.
Oh, yeah.
Imagine your portfolio just tanks, like 20% in 1 week,
Yeah.
because a couple of those companies miss earnings or something.
How would you feel? Would you panic? Would you sell? That's the real test.
And these aren't just, made-up scenarios.
Not at all. Take Netflix, a classic example.
Huge winner long term.
Absolutely. Investing early could have made you incredibly wealthy. But to get those massive long-term gains, investors had to stomach an 80% plunge in the stock price back in 2011.
80%. That's almost everything.
Imagine watching that happen to your money. Almost all your potential profit, maybe even a chunk of your initial investment, just gone. Poof.
The pressure to just cut your losses and sell must have been immense.
Unbelievable pressure. So the key takeaway isn't trying to perfectly avoid those drops, because doing that probably means you miss the big gains too.
Right. You can't time it perfectly.
No. Instead, it's about understanding your own tolerance for that kind of roller coaster before it happens.
Knowing yourself.
Yeah, and structuring your investments so you can actually stick with the plan, so you can hold on even when things look really, really scary.
It definitely reframes how you should think about chasing those big returns. And it's not just the high flyers, is it?
No, not at all. Even seemingly safe investments like, say, the S&P 500 index.
The whole market, basically.
Right. It's had major downturns historically. There was actually a period where it stayed 20% below its previous peak for 13 years.
13 years just to get back to even. Wow.
And we've seen several drops of over 50% throughout history. So yeah, investing can build wealth. Definitely.
That's the goal.
But you absolutely have to accept that uncertainty and that psychological cost of volatility. They're just baked into the process. They're part of the deal.
Okay, so volatility is the price of admission. We accept that. But then let's say we are seeing some gains. Another problem pops up, doesn't it?
Mm-hmm.
How do we stop wanting more and more? How do we avoid that trap of comparing ourselves to others?
Ah, yes. The enough question. That's our next theme.
It's tough.
It really is. Capitalism is amazing at creating wealth, but sort of as a side effect, it also breeds envy and comparison.
Constantly. You're always seeing someone who seems to have more.
It makes you feel like you're somehow falling short, even if objectively you're doing great.
It's so true. Think about like someone earning $500,000 a year in the U.S.
Okay, top 1%, doing very well.
Objectively, yeah. Enough for a really comfortable life, right?
Yeah.
But does it always feel like enough?
Often not, it seems. The goalposts keep moving. Housel gives this great illustration.
The chain of comparison.
Yeah. So you've got Bill, the doctor, making his $500 K. Feels good. Then he moves into a nice neighborhood, and his neighbor is Stan, a CEO pulling in $10 million a year.
Ouch! Suddenly 500K feels less impressive.
Right. But Stan, he knows Michael Jordan. Net worth in the billions.
Okay, another level entirely.
And even Jordan, he might be at some charity gala and bumps into Jeff Bezos.
Who made what, $75 billion in 1 year recently?
Exactly. And has a net worth of like $200 billion. It just never ends. There's always a bigger fish.
Always. And constantly looking up that chain, that comparison game, it can lead to really bad decisions, can it?
Hugely damaging.
Hmm.
People take on way too much debt trying to keep up appearances.
Or chase insanely risky investments hoping for a quick score.
Or worse, illegal stuff like insider trading. We see those headlines.
And beyond the financial risk, people sacrifice things that actually matter more.
Yeah, like time with family, their health, their peace of mind, all chasing more.
Losing sight of what they already have that's truly valuable.
So this is a really crucial point for you, the listener, to think about. At some stage, you have to define what enough means for you.
Your own definition, not someone else's.
Precisely. You need to be really conscious about not sacrificing the things you have and need your well-being, your relationships, for things you don't really have and maybe don't even truly need.
Just to keep up or hit some arbitrary next level.
Right. That constant striving can be a trap.
Thinking about what's enough and what satisfies us, it kind of naturally leads to thinking about why people make such different, sometimes baffling financial choices.
Which brings us neatly to our next point. The idea that crazy is relative.
Yeah, it's so easy to look at someone else's spending or saving habits and just think that's completely irrational.
They're crazy, like buying some frivolous thing we wouldn't touch or maybe hoarding cash under the mattress instead of investing it.
Right. Immediate judgment.
But we really need to pause before jumping to that conclusion. Everyone's financial decisions are shaped by their unique experiences, their background, their upbringing, their personal values.
All that stuff shapes how you see money.
Absolutely. So what looks totally illogical to you might actually make perfect sense to someone else based on their life story and their worldview.
The book has that really striking example about lottery tickets, doesn't it?
It does. In the U.S., people in the lowest income group, on average, spend about $400 a year on lottery tickets, which is 4 times more than what the highest income earners spend.
Wow, 4 times more. And
Right. yet, something like a third of that same lower income group couldn't pull together $400 for an emergency.
So spending on lottery tickets what they don't have for a basic emergency fund, on the surface that sounds crazy.
It does seem completely counterintuitive from a purely financial planning perspective.
Yeah.
But try to step into their shoes for a moment. If you're facing really significant financial hardship, maybe limited job prospects, few pathways to dramatically improve your situation.
Okay.
That lottery ticket, however small the odds, might represent hope. It's a small price for a chance, even a tiny one, at a life-changing amount of money.
So less about rational investment, more about buying a dream.
Kind of. It's maybe perceived as one of the few accessible ways to potentially escape their circumstances. Does that make it a good financial decision statistically? Probably not.
No.
But does it make the person crazy? Maybe not. It's understandable within their specific context, their lived reality.
That's a really important shift in perspective, and it connects directly to our own investing, right?
Absolutely. It means you shouldn't just blindly copy what others are doing.
Just because someone else, maybe a friend or someone online, is piling into a certain stock or strategy.
Doesn't mean it's right for you. Your goals are different, your risk tolerance is different, your financial situation is unique.
Like, a billionaire managing their wealth is going to invest very differently than someone in their 30s trying to build wealth for retirement.
Totally different objectives. One is about preservation, the other is accumulation, which often involves taking more calculated risks.
So understanding this relativity of crazy helps you navigate hype, too.
Definitely. Think about market fads, like the whole GameStop mania a while back.
Oh, yeah. That was wild.
If that kind of super speculative trading doesn't fit your personal strategy, your risk appetite, it's perfectly okay to just sit it out.
You don't have to jump in just because everyone else seems to be.
Exactly. Recognize that other people have their own reasons, their own motivations, even if they seem irrational to you. It helps you make calmer, more personalized, less emotionally driven decisions.
And beyond investing, just understanding different financial perspectives probably makes us a bit more empathetic and less judgmental overall.
I think so. It fosters better judgment all around.
Okay, so building on that idea of individual circumstances and different perspectives, our next theme dives into those big, unexpected events that kind of come out of nowhere and affect everyone, regardless of their plans.
Ah, the financial equivalent of a sudden game of peekaboo, but not fun.
Definitely not fun. Think about huge historical events: the Great Depression, World War II,
The 2008 financial crisis.
or even, the COVID-19 pandemic more recently.
Yeah.
What's common to all of them is suddenly they had massive impacts on markets, on lives.
And crucially, they were basically impossible to predict beforehand with any real accuracy.
Which brings us to Nassim Taleb's concept, right? Black swan events.
Exactly. Caleb's framework is really useful here. Black swans have three main characteristics. First, they're extreme outliers.
Meaning they're super rare, unexpected, nothing in the past really prepares you for them.
Right. Past data doesn't signal their possibility. Second, they have a massive, often transformative impact.
Game-changing events.
Definitely. And third, this is the really interesting psychological bit. After they happen, we tend to look back and convince ourselves they were predictable.
Oh, the hindsight bias. We should have seen it coming.
Exactly. Even though before the event, almost no one did. It's so easy to feel like the future should have been obvious in retrospect.
Yeah. Think about Black Monday back in 1987. The stock market crashed almost 25% in a single day.
Unprecedented at the time.
If you were invested back then, imagine the sheer panic. What would your gut reaction have been?
It's easy now to say, oh, I would have bought the dip. But in that moment, fear is overwhelming, uncertainty.
And acting on that fear can be incredibly costly.
Hugely. There's a striking statistic about this. If you invested in the S&P 500 over a 20-year period, but somehow managed to be out of the market for just the 4 best trading days.
Just 4 days out of 20 years?
Yep. Your total return would have been cut almost in half.
Yeah.
Slashed from around 291% down to 164%.
Wow. And often those best days happen right after the worst days, don't they?
Very often. People panic, they sell near the bottom, and then they miss the sharp rebound when it comes.
So the big lesson here is trying to perfectly time the market, dodging the bad days and catching the good ones.
It's basically impossible to do consistently. It's a fool's errand, really.
So instead of trying to be a psychic or listening too closely to, like, macroeconomic forecasts,
Which are often just educated guesses anyway.
the smarter approach is to focus on building an investment strategy that's robust, that's sustainable for you.
One that can actually withstand these unpredictable storms when they inevitably hit.
Preparing yourself psychologically, like staying disciplined.
That's a huge part of it. And preparing financially, too, having a well-diversified portfolio, maybe keeping some cash on hand for emergencies or opportunities, that's the most effective way to navigate these black swans.
You can't predict them, but you can prepare to endure them.
Exactly. Build a ship that can handle rough seas, because rough seas will come eventually.
Okay, building on that idea of navigating uncertainty and psychological challenges, our final theme looks at a bias that often clouds our judgment when we think about the future.
Ah, yes. The powerful, almost magnetic pull of pessimism.
It seems so easy to find reasons to be pessimistic, especially about the economy or the markets, right?
Oh, absolutely. You can always point to something worrying. Government debt levels are too high. Inflation is out of control. Geopolitical tensions are rising. There's a new virus variant.
Yeah, you list those things out, and it quickly sounds like we're on the verge of collapse.
It creates this sense of impending crisis very easily. Now, contrast that feeling with how we react to optimistic trends.
Things like people living longer, healthier lives.
Yeah, or the cost of renewable energy plummeting, or the incredible advances happening in AI and medicine.
We kind of acknowledge those good things, but they don't grab you emotionally in the same way.
Exactly. They don't usually feel as urgent or impactful as the negative news.
And there's a deep psychological reason for that, isn't there? Something about how our brains are wired.
There is. It goes back to Daniel Kahneman's work on loss aversion. We feel the pain of loss much more intensely than the pleasure of an equivalent gain.
Losing $100 feels worse than finding $100 feels good.
Precisely. And evolutionarily, it makes sense too. Our ancestors, who were hyper-alert to potential threats, predators, starvation, bad weather, were more likely to survive and pass on their genes.
So we're kind of hardwired to pay more attention to the bad stuff.
It seems so. Plus, think about how progress usually happens. It's often slow, steady, incremental.
Yeah, rarely makes headlines day to day.
Whereas disasters, setbacks, crises, they're often sudden, dramatic, and make for much more compelling
So
stories.
negative news gets more attention, it's more memorable.
Right. But here's the critical point.
Hmm.
Just because pessimism is more attention-grabbing, more alluring emotionally, doesn't mean it's more accurate as a long-term forecast.
Good point.
Real long-term investment success generally relies on understanding and having some faith in the overall long-term trend of human progress, innovation, and economic growth,
Mm.
despite all the setbacks.
Like that quote from Hans Rosling.
Yes. The world is actually much better than you think. It's easy to forget that amidst the daily noise.
Okay, so let's try and pull these threads together as we wrap up. We've talked about accepting market volatility, those ups and downs, as basically the entry fee for potential long-term gains,
Hmm.
the price of admission.
We've hit on the importance of defining enough for yourself, trying to resist that constant, often damaging social comparison game.
Avoiding the never enough trap.
We looked at why seemingly crazy financial behavior might actually have its own logic when you understand someone's background and perspective.
The relativity of crazy, yeah, fosters empathy.
Then we talked about preparing for those unpredictable black swan events rather than trying, probably futilely, to predict them.
Focus on resilience, not prediction.
And finally, just now, recognizing the strong pull of pessimism, but understanding that realistic optimism, grounded in long-term trends, is often a more useful guide for investors.
Right. Prepare for the worst, but kind of bet on the slow march of progress continuing. So it comes back to understanding yourself, your own tolerance for risk, defining your own goals.
And building a strategy you can actually stick with through thick and thin, resisting envy, panic, and excessive pessimism.
This has been really insightful, but this deep dive, we've really only just scratched the surface of Morgan Housel's book, The Psychology of Money.
Oh, absolutely. There's so much more depth and nuance in the book itself.
So if these ideas have resonated with you at all, if they've sparked your curiosity,
We strongly, strongly encourage you to actually pick up the book and read it yourself.
definitely. You'll get a much richer, more comprehensive understanding of all these crucial principles for navigating your financial life.
It's well worth the read.